This is Nightly Business Report with Bill Griffith and Sue Herrera.
Buyback binge. Corporate America is expected to buy back more shares than ever, $1 trillion worth this year. What are the ramifications for the market and investors?
Calling it quits. PepsiCo's longtime CEO Indra Nooyi is stepping down. What next for the company, the industry, and now for women in the C-suite?
And take a break. Why more and more big-name companies are adding sabbaticals as a major perk. All that and more tonight on Nightly Business Report for Monday, August 6th.
And we bid you good evening, everybody. Welcome for this Monday. Stocks started the week in the black thanks to strength in technology, especially Facebook. Shares of the social media company rose 4% today on reports it's in talks with banks to allow Facebook users to use its Messenger platform for financial transactions. That in turn helped push the NASDAQ higher for the fifth straight day. First time the NASDAQ has done that since May. Here are the numbers. When all was said and done, the Dow rose 39 points to 25,502. The NASDAQ climbed by 47. The S&P added 10 points today.
And while Facebook did have a big say in the NASDAQ's move today, Goldman Sachs says investors should focus on something that might have a key influence on the market overall. Goldman says this year will be a record for stock buybacks. Ready for it? The firm estimates buybacks will hit $1 trillion. Bob Pisani has more.
It's not just a big year for earnings, it's also turning out to be a big year for buybacks. Now, buybacks are expected to rise 46% from last year to a staggering $1 trillion. Why the buyback binge? Well, partly because of tax reform, but also because of revenue growth, which has been a very big contributor. Here's the good news. August is the most popular month for repurchase executions. It accounts for about 13% of annual activity. It's even possible that this recent rally is partly fueled by buybacks. The buyback blackout period has ended for most companies, so companies can resume buying again. Not surprisingly, the tech sector in particular will benefit from surging buybacks. Tech has accounted for 40% of the year-to-date repurchase authorizations. Now, here's the bad news. We have to point this out every time. Not all buybacks are created equal. It's share count reduction that you want. And while some companies are indeed reducing their shares outstanding by buybacks, Apple's a good example. They've been reducing their shares outstanding by about 5% each year since 2013. That's a lot. But many others are increasing their share count by offering new options to management. They're increasing. Often at the same time they announce the buybacks. So in the long run, it's all a wash, and the share count does not go down for the stock. Well, that's a waste. Indeed, while the S&P overall saw a share count reduction in 2016 and 2017, the total number of shares outstanding in the S&P dropped. So far this year, the total share count of all the companies in the S&P has increased about 0.5% this year. Well, that doesn't help. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Joe Duran joins us now to talk more about these stock buybacks, what it means for the market. Joe is CEO and founding partner at United Capital. Joe, welcome back.
Thank you. It's great to be back.
You know, companies get criticized for these buybacks in some cases. Couldn't they find better use for this money? You know, and is it financial engineering to some degree? But what about the impact it has on the market and investors?
Well, it's obviously great for investors when this happens because you're increasing the number of buyers and reducing the amount of stock. As Bob pointed out accurately, a lot of companies simply do it as a way to transfer wealth to management. Those are the times where it doesn't work out so well because what you're doing is reducing the share count and then transferring options to management. However, there are two places where it works really well. One, where you have a company with a very big war chest, an Apple, which has brought in the money from offshore with the tax repatriation and now can use the money as a dividend or to buy back stock. That's great for investors. It increases the amount of earnings for each share, which actually reduces PEs. Mm-hmm. That's fantastic for everyone. The cases where it doesn't work so well, again, when it is financial engineering. And typically it's the companies with the highest earnings, the highest cash flow, and the most balance sheet that can do it. It is negative in one sense that if that's the most efficient use of their money, it suggests that maybe that's not a high growth company. It doesn't have the ability to put the money to give you a return on equity, but it's still better that they return the money to shareholders than hold on to it on a balance sheet and make 2 or 3% on their cash.
Is there a significance to the Goldman estimate that we might see $1 trillion worth of buybacks? You know, we try not to focus on those big round numbers all the time, but that's a pretty sizable number.
Yeah, again, you should think of it more like noise. You know, temporarily it can offset the underpinnings of the economy, so it can look like when a stock declines, it can create a floor because the company can buy back its stock, and that can be good. It buffers the volatility. However, over the long term, what drives stock prices are earnings and GDP, and those things are insurmountable for any company, no matter how big its war chest. Ultimately, if the company isn't growing its earnings, if it doesn't have a return on equity, its valuations will end up, the stock will end up going down. So again, it's kind of like when countries try to support their currency,
right.
They can do it for a while, but it's not a lasting legacy.
Indeed. Joe Duran with United Capital, thanks again for joining us tonight.
You bet.
Well, it certainly seems like Wall Street has been hitting a lot of milestones lately, whether it's the $1 trillion in buybacks or Apple hitting $1 trillion in market value. They are signs that the bull market is a mature one. But as Mike Santoli tells us, that might not be a bad thing.
Wall Street is busy commemorating several market milestones this summer. In less than 3 weeks' time, the bull market is due to become the longest of all time. About a month later, the anniversary of the failure of Lehman Brothers will mark a decade since the great financial crisis. And of course, last week, Apple was celebrated for becoming the first U.S. company to reach $1 trillion in market value. All of these moments reflect how long markets have been climbing, and they prompt the natural question of how much longer the good times can last. The bull market's rank as the longest ever dates its start to March of 2009 and rests on an assumption that the January 2018 record high in the S&P 500 is ultimately surpassed before the index declines at least 20%. This simple definition of a bull market as continuing unless the S&P falls 20% or more is widely used, but sometimes disputed. Some strategists look back at two severe broad downturns in 2011 and in 2015 when broader market gauges other than the S&P 500 lost 20% of their value as important setbacks that reset the clock on this bull market and perhaps makes it a bit younger than its technical age. The 10-year anniversary of the Lehman implosion is instructive for investors as well. The average annual return over the past 10 years for U.S. stocks is a bit more than 10%. It's just about the historical long-term rate of appreciation for equities. Keep in mind, 10 years ago today was right before the market was to lose nearly half its value over the next 8 months. So that 10% annual return since then represents quite a revival. Still, when major bull markets do end, the average yearly gain over the prior decade has typically been above 15%. So there's nothing about how far stocks have come since 2008 to suggest any painful payback is necessarily due. As for Apple hitting $1 trillion, that's almost entirely a matter of normal inflation, the general rise in equity market value, and the enormous economic power of Apple. For the largest stock in the market, Apple does not have a particularly outsized weighting in the S&P 500. It's around 4%. And its valuation is supported by its $250 billion in annual revenue and a profit total that's unmatched in corporate history. And it is not notably inflated by speculative excess among investors. Now, none of this means stocks can't enter a tailspin if, let's say, the economy slows dramatically or trade wars hit corporate profits. And we now have a market that no doubt has more gains in the rearview mirror than it has waiting up ahead of it. But passing these landmarks doesn't suggest the market's heading for the end of that road all that soon. For Nightly Business Report, I'm Mike Santoli.
Now, as Mike mentioned, Apple makes up about 4% of the S&P 500. But how influential does that make it to the rest of the market? Dom Chu takes a look.
Apple is huge, and that characterization was solidified with its now $1 trillion-plus valuation. That pinnacle of market capitalization also means that for market cap-weighted indexes like the S&P 500 and NASDAQ Composite, Apple is the most influential stock. Apple currently makes up over 4% of the S&P 500, and by comparison, Microsoft carries a 3.5% weighting. Google parent company Alphabet is a little over 3%, as is internet retail and cloud computing giant Amazon.com. And then social media company Facebook comes in a distant fifth with a nearly 2% weight. So, is Apple the most influential stock of all time? Not quite. According to S&P Dow Jones Indices analyst Howard Silverblatt, other titans of American business have had more of a weighting in the S&P 500. In data going back to 1980, he looked at year-end weightings for the biggest companies out there. Turns out that Microsoft was nearly a 5% weight in the dot-com era of 1999. ExxonMobil was worth 5% during the financial crisis in 2008. AT&T was a 5.5% weight back in 1981. And it's Big Blue, IBM, that was a nearly 6.5% weight of the S&P back at the end of 1985. Now, just for some perspective, the S&P 500 market value at the end of July was right around $25.8 trillion. Hypothetically, if Apple were to become worth 6.4% of the index, it would be worth, hypothetically, over $1.6 trillion. Apple still has a lot of work to do to reach that kind of valuation. For Nightly Business Report, I'm Dominic Chu.
It is time to take a look at some of today's upgrades and downgrades. Barclays is downgrading shares of Intel from overweight to equal weight. The firm saying the best is behind Intel and its server business, and that margin pressures could intensify next year. Barclays also shaved the price target 15% to $53. Intel closed today at $49.30, down 3 cents. Qualcomm is being raised at Cowen from market perform to outperform. The analyst citing lower spending, its abandoned bid for the chipmaker NXP, and Qualcomm's $30 billion buyback. Cowen also raised the price target to 80 from 64. Today, Qualcomm closed at 65.73, up 0.5%.
Cowen is also upping chip equipment maker Applied Materials from market perform to outperform, citing attractive valuation and a rebound on spending on its wafer fabrication equipment. The price target was raised slightly to $62 a share. Shares finished at $49.48. That was up more than 1% today. Atlantic Equities is upgrading Comcast from neutral to overweight on fewer concerns about Comcast's future now that it has dropped that bid for 21st Century Fox assets. The price target was raised from $34 to $42. And we need to point out Comcast is the parent company of CNBC, which produces this program. Shares of the company closed down 9 cents at $35.32.
Toys R Us is gone but not forgotten. The now defunct retailer is leaving quite an impression, even though its stores are closed. First, overall toy sales were up 7% in the first half of this year, and an industry advisor for the research firm NPD Group thinks some of that sales growth is because of empathy that people felt towards losing Toys R Us. Then there's last week's jobs report, in which economists blamed the company's closing for the report's weak headline number. And now the laid-off workers are taking aim at private equity. Leslie Picker has more.
About 1 month ago, Toys R Us closed for good, but the controversy surrounding its 33,000 displaced workers has only amplified. The July jobs report was a bleak reminder of the retail casualty belying the otherwise healthy employment picture.
We are rising against greed.
Some of the toy store's laid-off workers have been seeking redemption. They're taking aim at the private equity firms that acquired Toys R Us in a leveraged buyout in 2005. The workers argue that the PE firms paid themselves hundreds of millions of dollars, even as they let Toys R Us slip into bankruptcy. The workers have garnered support from members of Congress who wrote a letter to the three firms, Bain, KKR, and Vornado, urging them to do something to help. Both New Jersey's U.S. senators and one congressman have rallied with former Toys R Us employees demanding severance.
This storied New Jersey company was run into the ground by a bunch of corporate raiders looking to turn a profit. These companies drained Toys R Us of its resources and its ability to adapt in the marketplace. And they treated its workers, employees like Robert and Shakina, as expendable, as afterthoughts, as collateral damage.
Last week, the Toys employees were on Capitol Hill asking for legislation that includes more worker protections in PE investments. For their part, the PE firms appear to be willing to provide some aid for the former Toys R Us employees outside of the bankruptcy process. In a letter back to Congress, KKR said that they did not want Toys R Us to be liquidated, but it was forced by creditors.
in private equity, it wasn't their goal to dismantle this company. It was their goal to buy it and make the company more profitable, and then come out of it. But things change.
KKR said they did not profit from the investment. For Nightly Business Report, I'm Leslie Picker.
Coming up, Dow component and widely held company Disney is scheduled to release its latest earnings tomorrow. What are the expectations for the Magic Kingdom? Shares of Sprint and T-Mobile got a lift today following a report in the New York Post saying that the Justice Department now believes that just 3 national 5G carriers are needed to provide sufficient competition in the telecom industry. Investors seem to take that as meaning that the prospects of the $26 billion merger between these 2 wireless carriers is being approved may have improved as a result. Both companies were sharply higher on the day.
Tomorrow, after the bell, Disney is expected to release its third quarter earnings. The shares rose nearly 2% ahead of those numbers. Julia Borston takes a look at what investors should expect.
Disney's expected to have a strong quarter, thanks to strength at the theme parks, the success of Avengers: Infinity War and Incredibles 2 bolstering the studio, and overcoming the disappointing performance of Star Wars spin-off Solo. Analysts project earnings will grow over 23%, while revenue is expected to grow nearly 8%. The division facing the most scrutiny, media networks, which includes ESPN, as investors watch the trend of cord cutting and examine subscriber losses. After last quarter, Disney said its subscriber base fell by about 3%. On the flip side, we'll see how much digital initiatives such as ESPN Plus and revenue from skinny over-the-top bundles are compensating for traditional declines. Investors will also be looking for details of Disney's streaming service in the works set to launch next fall. We don't know how much Disney will charge for the app, which will include a live-action Star Wars series, plus other original TV series and movies, as well as hundreds of films and thousands of TV episodes from Disney's library.
It is all about content. Whether you're cutting the cord or skinning the bundle, unless you have content, people will be staring at a blank screen, and they are the king of content.
We're also watching to see if CEO Bob Iger gives any update on international regulatory approval for Disney's acquisition of Fox, or whether he wants Fox to make a higher bid for Sky to top Comcast's current offer. And any insight into how the company will change as a result of its mega merger could impact investors' outlook. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Visitor turnout impresses at SeaWorld, and that's where we begin tonight's Market Focus. The theme park operator said that new attractions and promotions, which, by the way, included free beer, caused attendance to rise in all of its parks. Both earnings and total revenue saw gains as a result. Attendance famously suffered at SeaWorld after that 2013 documentary called Blackfish alleged that the company mistreated the killer whales in some of its shows. Shares today rose almost 17% to $24.69. Newell Brands cut its earnings forecast for the 4th time this year after it reported weaker quarterly sales and profits. The maker of Elmer's glue and Sharpie markers said the bankruptcy of Babies R Us, which sold many of Newell's products, and the retailer's cutting inventory put a dent in its own results. Shares of Newell Brands were off 14% to $22.76. Meanwhile, Rite Aid is also cutting its full-year outlook. The drugstore chain revised its guidance for fiscal year 2019, saying that it overestimated the cost of generic drugs when it initially made that forecast. The news comes just 3 days before Rite Aid shareholders are set to vote on the company's proposed merger with the Albertsons grocery chain. Rite Aid shares fell nearly 10% today to $166.
After the bell, Zillow said it was buying a national mortgage lender. Up until now, the company has remained focused on providing listings and quotes. It said the deal with Mortgage Lenders of America will allow it to create new partnership opportunities and potentially originate mortgages. Separately, the company reported a rise in revenue, but the shares plunged in after-hours trading. They ended the regular day up 1% to $59 even. After the bell, Hertz said each of its divisions saw growth this quarter, helping the car rental company narrow its losses. Revenue also inched higher, and it topped estimates. Shares, though, were volatile in the extended session. They ended the regular day down 1.5% to $15.67. Also out after the bell, Weight Watchers raised its full-year earnings outlook after reporting better than expected earnings and improved margins. Those results were overshadowed, though, by weaker subscriber growth. Shares initially were lower in after hours, but finished the regular day up a fraction to $92.21.
PepsiCo's CEO is stepping down after 12 years at the helm. The company said that Chief Executive Indra Nooyi, one of the nation's few female CEOs, will leave her role this October and stay on as chairman until early next year. She'll be replaced by PepsiCo's current president. Under Nooyi's leadership, PepsiCo's stock climbed 80%.
Joining us now is Eric Gordon, professor at the University of Michigan's Ross School of Business, to talk more, not just about Ms. Nooyi's legacy at PepsiCo, but the future of female CEOs in the C-suite. Good to see you again, Eric. Welcome back.
Hello, Sue.
Let's start, first of all, with Indra Nooyi. She was part of a relatively small and very elite group of female CEOs. Do you think she's going out because she's achieved what she wanted to achieve?
I think she's achieved a lot of what she's wanted to achieve. She was CEO for 12 years. That's a long time for any CEO, and she was a CEO in a tough business, and I think she navigated the waters very well.
You know, she's part of a generation, though, of women CEOs that came up together about the same time. Meg Whitman and others, Mary Barra now at General Motors, but there aren't a lot of younger women coming up through the ranks these days. We still don't have enough women on boards these days. Why isn't more progress being made at this point, Eric, do you think?
You know, that's a hard question to answer, and I think the boards had better start answering it, because if you look at Meg Whitman, Mary Barra, Indra, these are CEOs who've done a very good job, in Meg's case, at a couple of companies. So if we are not putting younger women in the slots that are preparing them to step up, that's a big mistake. We need that talent.
You know, I found it interesting that of the S&P 500, there were only 25, if you include Indra Nooyi, CEOs. You mentioned the board component, but what else do you think it is going to take to encourage more women to achieve the CEO position of a publicly traded company? We have a lot of women in privately held companies that are CEOs or founders of their own companies, but not necessarily in publicly traded companies.
Yeah, I think the women have to be given training and mentoring and opportunities in how you deal with being in a public company, being in the scrutiny of equity analysts, being under the gun from activists, as Indra was. You know, Trian, Nelson Peltz was after her. So I think they need a special kind of training to be able to run a public company, and I think we're not doing enough of that yet.
On that note, Eric Gordon, thank you so much for joining us.
My
He's
pleasure.
with the University of Michigan's Ross School of Business.
And up next, why some of the nation's biggest companies are giving employees more time off the job. The Trump administration says it will reimpose economic sanctions on Iran that were lifted under a 2015 agreement to curb Iran's nuclear program. The sanctions would target Iran's purchases of U.S. dollars, metal trading, coal, industrial-related software, and its automotive sector. The administration says the goal is to get Iran to stop its nuclear enrichment and to curb its weapons program.
In an increasingly tight labor market, companies are getting creative when it comes to offering employee perks. They have to be competitive to attract and retain top talent. And as Eric Chemi tells us, that trend is growing.
While LeBron James is vacationing in the Caribbean, there's no off-season when you work for the NBA League office. With the WNBA, NBA 2K League, the draft, Olympic basketball, it's become a 24/7 operation all year long. For Carrie Tatlock, Senior Vice President of Global Marketing Partnerships, that means constant travel, meetings, late nights. For other employees, it could mean burnout. That's why in 2015, the league created a new benefit offering employees with 10 years of service a fully paid 4-week sabbatical. At 20 years, they get 8 weeks off.
I call working at the league a way of life. You have to love it. You have to be part of it. You've got to accept that that's a way of life. But at a 10-year point, it's good to recharge.
For some employees, a sabbatical has meant quality family time. For others, it means travel. But for everyone, it's a rare chance to turn off their phones and unwind, knowing their job will be waiting for them upon return.
We went to Europe for 3 weeks, and to Germany and to Italy. We did the quick turnaround and ended up going to Western Massachusetts for a week. And I indulged in camp drop-off and pickup, making lunches, cooking dinners, being there every night for bedtime for the kids, and it was as extraordinary as the first part.
Nike, McDonald's, and Intel also offer similar programs. But the NBA is the first professional sports organization to offer this benefit. Experts say it's being increasingly used across all industries to retain highly valued employees in an increasingly tight job market.
Sabbaticals is certainly a way to do that, to reward people for their long-term standing with an organization. So we've seen it, not a ton, but certainly seeing it come out more and more.
For the company, it can mean finding future leaders.
To be a little bit blunt, I've said to most people when we first started, if this place can't survive without you for 4 weeks, we're in a world of hurt.
For Nightly Business Report, I'm Eric Chemi.
And before we go, a quick look at what happened on Wall Street today. Modest gains. The Dow climbed by 39 points. NASDAQ was the big gainer, up 47, and the S&P added 10. And that is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching.
I'm Sue Herrera. Have a great evening. We will see you right back here tomorrow.